Welcome back to another episode of Making Sense with me, John Napolitano. We're here to break down the big questions high net worth families face. You know, the ones your investment guy never talks about. No fluff, no finance 101, just straight talk to help you make smarter decisions and keep your wealth working as hard as you do. Let's get to it. Hello, everyone. I'm John Napolitano here with another episode of Making Sense and introducing you to the world of fully integrated financial planning. Today's topic is going to be business valuations. And I've got with me Bill Clement. Bill is managing partner of South Coast Financial Partners. What's happening, Mr. Bill?
How are you, John? Thanks for having me here.
Oh, you're welcome. Love having you on. So we're going to talk about why people need to get their business valued, how you get it valued, what are the consequences of all that stuff. And let's get started with this. You know, a lot of people start a business and they work their butt off and they don't really think about the value of their business. Well, intuitively, they may understand roughly what the value of the business is. They don't think about it too often. So let's talk about the reasons why someone might want to know the value of their business. And let me kick it off with the obvious to you and I, and that is the unplanned exit. What's an unplanned exit to your business? Well, it's you don't wake up for breakfast, you get permanently disabled, or something happens where the furthest thing from your mind, and that is leaving your business, happens tomorrow. You need to know the value of the business for that. How about the planned exit? You decide you want to sell. You're going to let some broker tell you what it's worth or let the buyer tell you what it's worth. And Bill, don't you think that many buyers or people that didn't realize they were going to sell the business get a call from someone, hey, we'd like to buy your business. What do you think about that? Is that a good thing to follow up on?
Absolutely. I think as a business owner, you should have a pretty good running idea of what your business is worth in the market that would be appropriate for you to sell. So this isn't a pie in the sky valuation, but it's kind of your own financial valuation of the business. And that's really a function of your profitability and your cash flow. We'll get into more of that. But there's also a number internally that you should know as a business owner of what you would be willing to sell. And you should constantly be trying to connect those dots. What is my business on paper in the market? And then also, what would I be willing to sell for and sell to a buyer under certain conditions?
You know, my experience is if you're getting a call from someone that you maybe know or don't know, and they say, hey, we'd like to buy your business, they're usually not the top bidder and they're going to try and lowball you. So that's kind of my feeling on that cold call,
Agreed.
if you will.
Agreed.
So then planned exit, you need to know what the hell your company is worth. Let's talk about the admission of partners. And there's kind of three ways to do this. You have, working partners, people that have just been dedicated employees forever, and you want to keep them around. Well, if you're going to give them equity or sell them equity, you need to have a basis for that valuation. And then two areas I'd like to kick over to you, Bill, with your extensive experience in this area. What about equity compensation planning? And that is basically stock in lieu of cash for part of your compensation plan, and perhaps the admission of a financial partner, whether it's private equity or whomever. Talk to us a little bit about those two, equity planning and financial partners.
Sure. So equity planning and equity compensation is a really useful tool, especially for startup companies and maybe more small entrepreneurial businesses that don't have a large cash stack or a large war chest to use to pay top dollar to get top talent. So instead, what they do is they create these equity programs that allow them to incentivize really talented folks to come into the business and work really hard. They're taking a lower salary than they might get at a large company like an Amazon or a Google. But instead, what they have is a little bit of a carrot on a stick, and that they share in the upside of the business success. So they're generally granted a quantity of shares, and those shares represent some percentage of the business. And assuming that there's a future equity event, a transaction, whether that's a recapitalization, somebody comes in and buys out the current equity holders in part, or the business is sold in a large strategic transaction. Either way, the idea is that that employee is going to cash in those equity shares and make a lot of money, a lot more than they would have if they had just gotten that regular salary from the Amazons of the world. So it is really a nice carrot on the stick, and it also helps the employees and the team feel like they're part owners of the business. They have a tendency to think more like owners, to spend less when they go out to eat on the company card and book travel and things like that. And it really gets them more incentivized to be part of the team. So as a business owner, you might be wondering, well, how do I break that valuation down? What are those shares worth to the team? And how do I set up this whole program? And the reality is that it is actually pretty complex, but if you have the right team on your side that's done this many times, they can walk you through this and there's a formula to make this work. And the team really involves a CPA that's been through this deferred compensation structure before, and then an attorney that can get this plan structured and set up with all the right documents and the right the language and the terms. And there's a whole other topic and probably podcast on that altogether in terms of structuring
Yeah.
those plans. But there's some rules that are involved. And the first is how you value those shares as you grant them to the employee. So when you're creating these plans, to follow what's called the 409A section of the IRC. And that dictates how those shares are valued to the employees in the grant.
So
And the
let's just
employee,
say, without getting too nerdy here, because we'll lose someone, that the IRS is absolutely needs to be aware of this valuation when you're using equity compensation. Frequently, there's filings or documentation as such. So, you may not be able to wing it. Not definitely wing it for sure. And I want to also allay a fear. A lot of owners, they never admitted partners. They never had partners before. And they have this misconception that if I admit a partner, I'm no longer in control. And that could really screw things up if we ever disagree on something. What's your thoughts on that?
yeah, admitting a partner is definitely a sensitive topic. It also depends on the other partners that you have already in the business. So, the important thing is that when you're valuing your business, is that you're agreeing on the way that the value is structured. There are multiple approaches that you can take to business valuation, whether you use your assets to value it, your cash flow, or you're just
Hmm.
looking at multiples of your business in comparison to the market. The idea is that you agree upon a valuation using a third party, an independent person that kind of coaches you through the different options and what makes the most sense. And then once partners are agreed on that, sticking to that formula year over year, and that helps you identify what is the value, what is the growth of that value. And at any time, you're in a position to potentially admit a new partner. And then you,
Yep.
as current partners, can decide at that point, how do we want to discount this? Or what does this new partner bring to the table that we should factor into this calculation?
One of the issues I wanted to bring up there is business owners, don't be afraid of admitting a partner. It could be the best way ever to get yourself world-class talent. And the legal documents can clearly limit the authority and sway and protect your downside for your new partners. Quickly, I'll get into maybe three other reasons why you want evaluation before we dive into the details of how the heck do you do the valuation. One of them is a merger. It could be very possible that one of your competitors passes away or dies or just wants out and they want to combine forces. And you may have always had your eye on that business. You need to know what your business is worth if you're going to put it up there for merger. Collateral, maybe collateral for a loan or any other purpose for borrowing or financing. And then last but not least, you didn't start a business because you just hate working for people, right? You probably started it because you wanted to do better, make a little more money, enhance your net worth, whatever. So it's a great way of tracking your progress. And Bill mentioned earlier, you get this valuation updated. It doesn't have to be formally updated every year, but you want it formally updated at least every couple, 3 years, or as circumstances change dramatically so that it really holds water with a potential merger, potential new partner, a sale, or the IRS in the event that you get audited over your equity compensation plan. Let's dive in now, Bill, under the mechanics. You wrote a wonderful article. It's located on the website for South Coast Financial Partners, southcoastfp.com. So if you want to read this in its full vim and vigor, you go for it. But we're going to summarize it for you right now. So Bill, let's start with a tax valuation versus a broker and investment banker valuation. And what's the difference between the two?
Sure. And I mentioned earlier about something like a 409A valuation. The 409A is an IRS prescribed way to value your equity. And ultimately, there's a big disconnect between that method and what the market would actually use to value your business and what the market would pay. So I always find myself coaching owners not to get bent out of shape about the fact that the IRS calculator spits out typically a much lower value than what the market would value. This is a tax issue, and the way that the IRS looks at your business is very conservatively. It's based on the data. It's not based on any strategic synergies or upsides or things like that. You do have to consider kind of what the future might look like, but they really want to provide more of a fair and a historical based way of valuing your business. So just think of it like a calculator. That's really the way that
Yeah.
the IRS does valuations.
So the
Whereas,
IRS is in effect doing you a favor there by giving you the opportunity to have a lower valuation, which triggers less income tax on the recipient of any equity in the case of equity compensation.
exactly that, and
Right.
as long as you've at least followed that method, you can avoid scrutiny. And there's always some levers that can be pulled that and management influence on valuation, but it's based on what is known and knowable to you as the management team as of the date of valuation. So as long as you follow those criteria, you're okay.
So if you make locks, for example, and you've been selling locks for, states, but your technology is fantastic. It might be worth, X dollars. But if some other big company comes in and says, oh my gosh, I can see 15 other uses for that product. And by God, our company actually works in all those areas. You might actually get a much higher valuation from a broker and investment banker. Isn't that right?
Exactly right. And that's hopefully what happens for most small business owners is that they position themselves in a way that they can take advantage of those synergies and be paid based on a strategic upside and not a financial calculator. So the investment banker and the broker, they're looking at market conditions, they're looking at buyer demand, how niche is your product, your strategic positioning, industry trends, all those things are factoring into your valuation in a way that the IRS is unable to do based on their calculator. So it's a much better way to look at your business when you start talking about future value
Mhm.
and potential upside in a sale, but it's not the tax efficient way to look at your business.
So when you're looking for a buyer, if you will, a strategic buyer is someone that has a vision for what they can do with your business, your assets, your technology, above and beyond what you've thought of. A financial buyer is someone that's going to grind it out and see how much they can get from an ROI just from buying and running your business as is. And that tends to be a lot lower, doesn't it?
It tends to be lower, and the financial buyers are again. There's another a whole other podcast on this topic, but they're motivated and they're stuck inside of a timeline. They have a certain amount of time to deploy the capital and buy your business, and then turn it over for their investors. And typically, that's an under 5 year period. So they're trying to get as much as they can in that 5 year period. It's a very different. It's also different than the IRS math, but even the financial buyers are looking at it in a discounted way versus the strategic buyers.
Mhm. Let's get a little nerdy now onto the main approaches to a business valuation. The first approach you talk about in your little white paper here is an asset-based approach. Talk to me about that.
This approach it's not uncommon, but it's not very favorable in terms of the value of a business, but it does have to be factored in. And this is when you have a business that's really focused on its assets, whether that's heavy equipment, trucks, manufacturing equipment, it could be real estate. And ultimately, the business itself, maybe the acquisition strategy over the years was its secret sauce, and it's really a business that should be valued based on what it owns, the assets that it has on the balance sheet. So it's not a very sexy way to value a business, but it is one of the ways that's used. And it's strictly, as it says here, it's just net assets. What are those assets worth? Fair market value, less the liabilities against those assets, the debt. And it's really a leverage style way to look at your business valuation.
Mhm. So it's not necessarily the only approach one would use, but it's something that's clearly factored in.
Exactly. And some businesses have done a really great job of building their balance sheet over the years. And maybe they're getting to the point where the cash flow or the year over year cash flow or income isn't what it used to be or isn't a great indicator of value. And ultimately, in that kind of valuation with assets, you're probably selling the assets of your business as well. So it makes sense in only certain circumstances to use that approach.
Let's go on to number two, which is an income-based approach. Talk to us about the income-based approach to valuation.
So it's basically looking at the cash flow of the business, the free cash flow, the seller's discretionary earnings, cash flow to owner. There's a lot of different ways that this is described. But ultimately, if somebody buys your business, what is the year over year net cash flow that they can expect to receive from it? And ultimately, you look at the historical earnings of the business, but also in the future 3 or 5 years. What does that net cash flow look like year to year? And then a financial buyer in particular would discount that back using an interest rate, typical math. And they would just try to understand the value of the business just based on its discounted cash flow and that return of capital year over year. It's a very financial, like we talked about financial buyers, a very financial way of valuing your business. It's not based on those strategic synergies and the sizzle to the steak and all those things. It's really for businesses that have very, very normal, predictable revenue streams year over year that are almost like a dividend stock. They're just going to kick back that cash every year.
Now, don't get scared, guys. If you're running your business out there and you're trying to be very aggressive from a tax planning point of view, or you're, paying some salaries that might be higher than what a third party might pay, all that kind of gets adjusted when you get down to putting out a valuation for your business. And some of it, we won't get into it too, is a separate topic, but is discovered through what's called a quality of earnings report, where the P&L, the cash flow kind of gets normalized for, well, what would I do if I bought your business? Would I keep your wife on the board of directors, for example? Maybe not. The third approach, the market-based approach. How the heck do you do this?
This is a much more challenging approach when you're running a small privately owned business. The market based approach is really focused on transaction data that exists. It's either publicly known or it's known through paid research studies. And essentially, your business has like we talked about, a regular annual operating rhythm. It has some income, and we can do some add backs and get to kind of an adjusted income or adjusted EBITDA. And
Mhm.
essentially, what we're looking at are what are comparable companies that are selling right now or have sold in the recent past, and what are the multiples of of their earnings in those transactions. So if there's another 3 or 4 publicly traded companies that are known and we're seeing them sell for 5 to 8 times that EBITDA figure, then we would use that multiple, that 5 to 8 times number, and apply it to your own company's cash flow or EBITDA, and use those multiples to drive the valuation. So that multiple itself, the 5 to 8x or whatever it ends up being, typically smaller deals is the 3 to 4x in the financial deals, and it can go beyond 8, it can get up to 10 or 12x. That multiple is driven by those strategic synergies, the upside to the buyer, all that sizzle to the steak, the things that we talked about earlier. That's really what sets that multiple. And then we're multiplying that by the adjusted EBITDA that the business earns.
Now, let's talk about some of the things we touched on quickly earlier, and that is maybe a discount for a lack of marketability. So if the paper valuation comes out to be, $5 million and you want to sell me 10%, should I pay 500,000 for that business?
This is a great topic, and it matters. What matters the most is the type of deal or type of transaction that's happening. If it's an internal deal between partners, or even a small investor that's coming into the business, the idea is that the business is valued in total. All the calculations that we've talked about are somebody acquiring the entire thing, and there's that regular cash flow and the assets and everything that make up the value, but also control of the entity makes up a significant value, and the ability to steer the business in one direction or the other. So if you're buying a piece of a business, in particular a non-controlling piece, then there's something called a DLOM, or a discounted lack of marketability, which factors in the fact that you're not buying 100% of the control of the business. And it also is a little bit of a fudge factor for the fact that you're not selling shares of the company on a stock market. There aren't 1,000 buyers and sellers that are constantly arguing and negotiating for the highest price. So if we used an 8x multiple from our market approach based on a publicly traded company, which has a bunch of buyers and sellers constantly driving the price up, and we're using that multiple for a small business, you have to factor in that there's really only potentially a handful of buyers in the mix. So all those things bring that value down. And again, in a tax situation like a 409A, this is a really good tool to make sure that you're not overvaluing your business for tax purposes.
We talked a little earlier about the difference between a strategic buyer and a financial buyer. Can you just once again sum that up for someone that was maybe a few years away from selling their business, why it may make sense to look for a strategic buyer?
Yeah, I would say both buyers could be a great fit for your business. If you're a small business owner and you're thinking about selling and you're not sure what the future looks like, both buyers could be a great fit for you. It really depends on your circumstances. The reason you would want a strategic buyer more than a financial buyer is that the strategic buyer has a lot more upside in the deal for themselves, and therefore they will typically pay you a lot more for your business. The idea is that they are operating in a similar industry or the same industry as you, and they are going to buy your business, not just for the cash flow year over year, but also the technology, the relationships that you have, the IP that you might have created. Maybe they're taking out a competitor. All those kind of intangible factors will drive value and ultimately cause them to write a much bigger check than a financial buyer, like a private equity firm, who are really looking more at that year over year cash flow. And they're also motivated by return on that invested capital. Those are the standards that they're held to by their own investors. So you just have two different buyers with two very different motivations for the deal. We're really watering it down here into just these two basics. There's a lot more that goes into this, but ultimately the strategic will always pay more because there's more in it for them.
Yep. At least, and they're not going to share that with you necessarily. So let's wrap this up now and let us know what it means to the business owners and some final thoughts that you may have.
Yeah, I think it's important that as a business owner, you have a good understanding of what your valuation is. Maybe you don't need the tax valuation as much as you are just curious as to what could your business sell for. And especially if you're 3 to 5 years away from either selling your business to your kids or your managers, or even to the outside market, knowing which style of transaction you're trending towards, and then getting the right kind of valuation to start moving towards that number, and working with your financial planning team to understand how much money do I need for my financial future based on my plan, and how many dots do I need to connect to get there? Am I way off in terms of where I'm valued at today versus where I need to get? That's a wake up call for some owners. And I think having that valuation ironed out earlier is always better. And then to get ready for that transaction, especially if you're going outside the business and selling to an investor or a strategic buyer, is just boosting your own diligence, making sure that your financial records are buttoned up. And a lot of this needs to be in order to get a valuation. So one kind of triggers the other, but having good, clean financial records, you have a good capitalization table, you know who owns the company, you have good tax returns and financial records. You have a very clean accounting system, and you can get data out of it, sales by product, sales by customer. All those things are important and can help you justify the value of your business. And then just being prepared to negotiate, understand, especially in an external sale, what are the main drivers of your value, and what are the drivers in that industry that'll help you support the price of your business, whatever that is. And then again, through that financial diligence process is having all the data to support those negotiating points. And all that can be done, and all these things can be addressed with the right deal team.
Bill, this was very good. I really appreciate you being here today. And,
Thank you.
remember, guys, you may not be looking to sell your business tomorrow, but you also may not wake up for breakfast tomorrow. And someone's got to figure out what the value of that business is for your estate tax return. Mr. Bill Clement, managing partner of South Coast Financial Partners. You will see in the year again. Thank you, Bill.
Thanks, John.
And we will see everyone next time. Thanks for tuning in to Making Sense. If you got something valuable out of today's episode, share it with someone who'll appreciate it. And don't forget to subscribe. One last thing. If you love the show, open your app and give the show a 5-star review. Until next time, thanks for listening to Making Sense.
The views expressed on this podcast represent the opinions of each speaker and are subject to change. These views are not intended as a forecast, a guarantee of future results, investment recommendation, or an offer to buy or sell any securities. The information provided is of a general nature and should not be construed as or used as a substitute for individualized investment, tax, financial, or legal advice or service to any person. Financial planning and investment advisory services are offered through U.S. Financial Advisors, a registered investment advisor. Certain representatives of U.S. financial advisors are also registered as representatives of Great Valley Advisor Group, a registered investment advisor. To learn more about Napier Financial, please check us out at napierfinancial.com.